Hello, good morning. Welcome back to Hurdle Rate. Today we're going to build the DCF model for Tesla. We're going to go from a blank spreadsheet right through to finding a fair value for this company. As you can see from the graph on the right, the stock price in recent years has been very volatile. It's had some very high highs, but also some very low lows. So let's dive right in and see where we think the fair value could be. Earnings were released the other day and they showed a good increase in top line revenue because of people pulling their purchases forward because of the EV tax credits disappearing soon. But there was also quite a bit of margin compression, which wasn't good news. So let's dive right into it. First things first, go to the SEC, search for Tesla, open the 10Q, and the 10K is on the second page, it's there. The 10Q, let me just come to the bottom. It should be at the top of the first page, this one. And we have both of them here. Go to, on the 10K, go to page 49, go to page 5 on the 10Q, and then let's switch onto the spreadsheet. For the spreadsheet, as always, remove your grid lines, go view, freeze that first column, go to A, insert another column, and make your A much smaller, make your B much larger. And there we have it. But why are my grid lines still there? There we are. In A1, I'll zoom in a little bit for you. In A1, type TSLA, the ticker for Tesla. Go data, stocks. Come on. Here we are, and select this one, TSLA on the NASDAQ. Okay, so let's get started. We want the ticker, the date, the current price, the implied from what we get from the model, and then if there's any up or downside. Do a bit of formatting. We want to put these in a color with the border just so it catches our border. Just so that we know where to look on the spreadsheet when we're looking at a glance. Now copy this over. There we go. In ticker, go equals A1 dot ticker symbol. In current, go equals dot price. The date today is the 26th of October, 2025. Leave these two blank because we can't put anything in there yet because they will come from the model that we've built or that we will build. Put an X here and just make it center so it looks neat. And let's fill this with this navy blue. Go font and change that bit to white. We call this section assumptions. And this is going to be revenue segment, switches, then bear, base, bull, just copy this down like that. The first revenue segment is going to be automotive sales, and that is obviously the largest revenue segment, the primary revenue segment for Tesla. In switches, put 2, and then they just we'll fill them all out now. So automotive regulatory credits, and these are likely, I guess, certainly during the Trump administration, will pretty much go to zero. They'll probably be they'll get rid of them. So whilst this is currently say it probably brings in about $2 billion a year for Tesla, we anticipate that going to zero during this administration. Energy generation and storage. What's the next one? Services. Services another. So copy this down. And the idea, and you'll see as we start building the model, These switches we can toggle. We can put 1 for the bear case, 2 for the base, and 3 for the bull, and it will allow us to simulate revenues based on whether we think we're bullish on the company or bearish. And we will also do that with the EBIT, the WACC, which is the weighted average cost of capital, and the terminal growth value. The EBIT is your earnings before interest and tax. It's also, I guess, you'd call it the operating income. So copy this down here, then copy these two, like so. So that's it. We've built our assumptions. We'll populate these cells as we're going through the numbers so that we can estimate what we think the performance of the company will be. So we want to go automotive sales, put that equal to B10. Percentage growth. Then we want bear, base, bull. Percentage of revenue. Anything that's a percentage, I always say, well, I think most people italicize. So, okay. Now let's get started. For the year, start with 2022, then go in the next cell, go equals the 2022 plus 1. So my C23 plus 1, then just copy that down, and we want to go to 2030. Okay, I can zoom in a bit more for you. There you go. Okay. Just format this so that they become numbers. We want number, we want the 1000 separator. We also want, what else do we want? We want to go number, 1000 separator. We don't want it to be to a decimal place. We want the brackets to indicate negative numbers. So start in 2022, so come on to the 10K. Revenue 67210. 78509 for 2023, 72480 for 2024. So as you can see, it was a big drop from 23 to 24. So to work out the growth rate, we take the year that we're looking at divided by the previous year minus 1. Then just convert it to a percentage, and you can just drag this along as so. For 2024, so for the first 3 quarters of the year, they did 53.8 billion and ended the year on just under 72.5. So we will take 72.5, divide that by 53821, 1.37. So for 2025, let's say it goes 4901 multiplied by 1.37218152. There we go. We want to forecast the next 5 years of revenue now. And to do this, we will start by going what we think the revenue is going to be in 2030. Actually, let's start with the average of the last 3 years. So, okay, maybe it's a 1% growth for next year on the let's say for here, we'll go with a 10% growth rate, because if he introduces a more affordable Model 3 and Model Y, that could really boost sales. I think that's maybe what customers are waiting for. The ones that bought recently because they want to get ahead of the tax credit, so a new model, a more affordable model, could actually offset the revenue from the tax credit. So let's be optimistic and say 10%, and we'll say by 2030, we could see it come back up to, let's say 17.5%, because they could end up, having more affordable models. They could be the robo taxis. They could be, I think, okay, let's go with that. Then to work out these three cells, we go equals we take the previous year, so in this case, the 2026, minus, open brackets, the previous year minus the final year, close brackets, divided by the end year minus the previous year, close brackets. And because we want to make this dynamic so that we can just copy paste for the rest of the model, we need to lock in certain components of this. So we don't need to do that with this one nor this one, but we want the column to always be K. We want the row to update as we're going down into the different revenue segments. We want this to always be fixed, so we lock in both the column and the row. Then for this, we want the row locked, but not the column. So we just put the dollar sign. If we want to lock something in, we just put the dollar sign in front of it. And there we have it. Let's just go percentage. We want 2 decimal places. Do a bit of formatting. And for the remainder of the 2 cells, you just copy it along. There we have it. So we're saying that next year revenue will increase by 10%. So we'd anticipate about what would that be? Another 6 billion. So it'd be 73, 74 billion in revenue on automotives, and this will grow at this sort of trajectory until we say by 2030 it's back up to 17.5%, which we saw happen here. So we need to put 17.5% there, and you need to make this cell equal to this one. So for me, it's G10. You put equal to G10, and that just means we can update all of these assumptions up here, and it will fill throughout the model rather than having to scroll down constantly and try and find where everything is. Whilst this can be actually quite, it can be quite unpredictable for Tesla. So instead of us going with our usual 95% of the base or the 105% for the bull, let's go with 90% for the base, and for the bear, and 110% for the bull. So you take the base, multiply it by the bear, lock it in, copy, pull it along. Now do the same with the bull, lock it in, and there we have it. So for the growth rate, we want to be able to simulate between these 3 different scenarios. So we use the offset function. And the first thing we write is the cell that we're in, G26, comma, select the switch, lock the switch in, then 0. And pull that along. There we have it. To work out the growth, the forecasted revenue, is we take the previous year multiplied by 1 plus the growth rate, close brackets. And there we have it. So let's say we think, oh, actually it's only going to be 9%. We put that in, and it adjusts to what a 9% growth rate would look like for next year. We can go bullish, and it updates. So what we can do now is we can just take all of this and we copy it down here. We change this one to B11, which is the automotive credits, and we start populating the correct figures. So in 2022, this was 1776 in revenue, 1790, 2763. For 2025, we take the 2024 divided by 2071, 1.33, and then we do 1451 multiplied by 1.3341381. There we go. And for this, let's average. No, I mean, this is going to go down to, let's go minus, say minus 25%. See what that looks like. or maybe even minus 100. Yeah, I think let's do that. And we have to, on a bearish, we have to go 1, 1. Change this to 11, so it corresponds to the correct cell. And change it to the appropriate switch. There we go. So what we're saying now is that we predict for next year, it will drop 30% again. And this will trend towards 0. So it will be minus 100%. So there'll be no revenue from the EV tax credits. On the bearish, we're saying it could go even worse. So this could fall 33%. On the bullish, maybe it falls just 27%, which is why we've done it the opposite way around to what we've done up here, because we're working with negative numbers. Now, let's go on to the next segment. We copy this. Did I? Yeah, that's fine. This is equals B12, automotive leasing. Come on back onto your 10K, 2476, 2120, 1827. Then for 2025, we can see that 1827 divided by 1380, 1311 multiplied by 1.32391304. Okay. And this is going down by quite a bit. Let's anticipate that. What should we say it does? Well, let's say it does 1% better per year. Okay, yeah, let's do it like that, because we don't really know. And it trends to 1%. G12. Change it to 12. Pull it along. When you're copy pasting, you've always got to make sure that you're just updating it to make sure it corresponds to the correct cell, so that it moves in the right way. I always forget to do it, but yeah, that's good. C12 looks good. Yeah. Okay. I mean, we don't necessarily have to get this too far right. It doesn't need to be too accurate, because it is a very small part of the top line revenue. I mean, it could have a big impact on the margin, but really, I mean, it's this bit that they need to get right. Okay, so yeah, let's go to energy storage. What was that? 12 equals B13. Actually, sorry, let's do it like this. Percentage of revenue, we can't do it until we know what the total revenues are. And this segment is a big, this one will be a big growth for the company. Look at that, 4 billion, 6 billion, 10 billion. No, I've got that wrong. 3909. 6035 and 086. Go equals divided by 7025. 8934 multiplied by 1.43572954. Let's go average. This will be a huge growth bit. So this could be still going at 50% per year. Let's go. Yeah, let's give it 50%. But we'll have quite. Maybe on the downside 80, but on the bull case 110. We'll do it like that. Okay, yeah. So I mean, this could be by 2030 nearly 100 billion in revenue for this revenue segment. Next one, service is another. And again, this one could be quite high growth because of this is where the robots are and the full self-driving. Divided by 7686. 9159 multiplied by 1.37054385. Yeah, and we'll put this to, let's say 25%. We'll put it at 90, keep it like that. Okay. Now we can sum up our revenue. Total revenue. That we just go sum. Make sure we get all of them. Should be 5. Yeah. Did I get that right? Yeah. Okay. Pull that along. Maybe for this one, we're actually going a bit too ambitious. 17% revenue growth in total for next year. Maybe change this to 5%. No, I think I think the forecast is about maybe 9% revenue growth in total. Yeah, I think that's, yeah, we'll go with that. We'll go with that. We could even make the robots a bit more. By 2030, that could be 50. Okay, let's do that. We'll build the, what do we want to do? We want to build the income statement now. We start with revenue. Second. And we just put this, make sure you put this equal to what we've just calculated up here. Pull it along. Do the same here. Then we want EBIT, and we want to know what the EBIT is as a percentage of revenue. That's your EBIT margin. The way we find the EBIT is we come on the income statement. So you have your revenues, then you have your cost of goods sold, which gives you your gross profit. Then you have your operating expenses. And then we have and that results in the income from operations, and that's our EBIT. So it's earnings before interest and tax. So it's 7197. Just make sure you format it correctly. 7197 8769. Pull that along. 8769. No, I've got that wrong. It's 13656 8891 7076. We want to know what this is as a percentage of revenue. 17%. Let's work out 2025. 5493. $2,946 multiplied by 1.28818,496. So forecasting this out, this is a placeholder bit now, so we will just do the average, pull it along, and then take the forecasted revenue divided by, multiplied by the EBIT margin, and that should give us what? But go on the next, when we actually build out the EBIT, where we can do a base, bear, and bull scenario, we will we'll have different scenarios. So this, I mean, we don't imagine Tesla's EBIT margin, the operating income, to be single digits for this long. I think these years are a blip, and it will come back closer to something like this. So taxes. Well, 1132 negative 501 negative 501 1837. We want to know what these are as a percentage of EBIT. So here's about a 25% tax rate. That's probably what we'll use going forward. 2025, where is it? Equals 2024 divided by, where is it? 1456. Equals 1098 multiplied by 1.26167582. Oh wow. But going forward, just put this to, for now, to 26%. Put it forward. There we go. Okay. Next are the cash flow items. And we find these on the cash flow statement, which is here. Normally goes balance sheet, income statement, cash flow items, or income statement, balance sheet, then cash flow items. But this one is always at the end. So we want depreciation, amortization, and impairment. So we want this line. Then we want CapEx, which is purchases of property and equipment, excluding finance leases, net of sales. Then the next thing we want is the change in net working capital, which is the sum of these here. So we go DNA, which is depreciation and amortization, percentage of revenue. And we also want to know what that is as a percentage of the CapEx as well. Then CapEx. Nope, sorry. change in net working capital. Okay, so 3747, 4667, 5368. As a percentage of revenue, we're going like that. Just format it, pull it along. 2025 is, where is it? Here we are. So as usual, we'll take the previous year, 2024, divided by 3872. So we go 4505 multiplied by 1.38, 636, 364. And going forward, okay, so yeah, let's go on to CapEx now. Actually, no, sorry, let's target this out for the next few years. We'll keep it at 6%, but CapEx probably have to put it maybe 7 to 9% of revenue. Okay, so let's go to the CapEx, which is purchases of property and equipment, excluding the finance leases net of sales. So 7158. 8898. 11339. We want to know what this is a percentage of revenue. Yeah, I think we can keep that. Whatever the average comes out of this is what we will have going forward. Just work out what depreciation and amortization is as a percentage of CapEx. Okay, let's find 2025. $8,562. Again, multiply the revenue. They're not spending anywhere near as much as Google, Facebook, Amazon, etc. So that might have to change. This could it could end up having to be, it could end up having to be more like 12-13% of revenue. I mean, as we saw on Metas, it was nearly, I think, 30-something%. It's, yeah, okay, change in net working capital. Where is this? This is here. We do the sum of these numbers equals the sum and in the brackets, it's negative. Just format it as so, divided by top line revenue. Minus 2652, 2605, 1532. sum minus 0183 plus, 937. Just use the sum function. You don't have to put an addition or subtraction sign in. Just do sum, comma, 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 and then it will do the calculation for us. But we do have to put, if it's negative, we have to put the negative sign in front of it. Okay, what's going on here? Okay, yeah, looks good. Next section is the actual DCF. Again, it's going to be, we're going to copy down the revenue from the top. To make this equal to here. Just pull this along. There we go. Then we want the EBIT. We want this as a percentage of revenue. Just copy this up to 2025. Pull this down. Sorry. Okay, so as we can see, the EBIT margin has been battered over the last couple of years. This is mainly due to well, obviously they've got price competition. They've had to reduce prices to maintain their volume. The competition being the likes of BYD in China, they are losing market share to them. There's also the regulatory credit decline. And these will probably disappear over the Trump administration. There's also the tariff impact, which they've said is approximately $400 million in quarterly tariff costs, and that is weighing quite heavily on profitability. The R&D spend, and that's heavy investment on the AI infrastructure and FSD development, that's really going to hit short-term margins, but we should forecast these to come back up to about, I'd say, 17%. So okay, let's put 17% here. A bullish, well, bearish is, we'll say 90% of that. And the bullish being, G16. 110 equals G16. Okay, yeah, it looks good. Change this to 16. Again, we have to do offset, the offset function. The cell that we're in, G93. Then we want the switch. For me, it's C16, but lock it in for both. And there we have it. We're anticipating, yeah, this on a base case to come back up to about 17% once the once all of that heavy OPEX has been done, and then it should come back to higher profitability. So let's go revenue multiplied by the EBIT margin. Pull that across. Yeah, there we have it. Taxes, percentage of EBIT equals Okay, sorry guys, pull this out. Let's see what an average would be. 2%. They're not going to be paying. Oh, that's fair. Let's do it like that. That looks okay. Then go EBIT multiplied by the tax rate. You see a huge tax benefit here. Yeah, let's go with that. Now we want to calculate the EBIT, which is your earnings before interest, but after tax. And all that is you take your EBIT and you subtract your tax. Bold it, pull it across. Now we want to know what the DNA, well, we know what they are, but we want to calculate the unlevered free cash flow. So pull all of these down from what we've calculated up here. Where's the CapEx? There it is. So to calculate the unlevered free cash flow, we go equals, we take the EBIT, we add back in depreciation and amortization because it's a non-cash expense, we subtract the CapEx, and we subtract the change in net working capital. Pull that across. So that's what we anticipate Tesla to generate in free cash flow based on the inputs that we've put up there. Now we want to work out the present value of the unlevered free cash flow. To do this, we need to build a WACC, a weighted average cost of capital. So open up a new sheet and let's do this. So what is the WACC? The WACC is the weighted average cost of capital. And to what we need to do, how are we going to do this? Okay, so yeah, you've opened up your new sheet. Type TSLA in the top. We need the ticker because there's still some of that we can pull here. Make the A smaller, this bigger. Obviously, remove your grid lines. So the WACC equals your percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. Okay, so market cap, that's the first component we need. We get that from going equals, open the parentheses, market cap, but make sure to divide it by 1 million because that's what the financial statements are in. So Tesla has a $1.5 trillion valuation. The percentage of equity, then we need the cost of equity. The components of the cost of equity are as follows: the risk-free rate, the beta, the equity risk premium. Then the next bit is we're going to move on to the other part, is the debt. Then we want the percentage of debt, cost of debt, and the tax rate. Below that, we go total, then we go WACC. Some of these we can calculate. Or some of these we already know. Others we have to calculate. So, sorry, let me just bold this so we can distinguish. Okay, we know that. Actually, let's leave the cost of equity until last. We have the market cap. Let's work out what the debt is. 27. So here's the balance sheet. The debt is, where is it? So 1924 plus 5778. plus 5778. So Tesla has about just 7.7 billion in debt. So it's very small in comparison to the equity portion. To work out the total, we go market cap plus your debt, which is, it's slightly more. This way we can get the percentage of equity. So we go market cap divided by total. So Tesla is a 99% equity company. The debt is very small. So yeah, less than 1%. We can even, let's add a couple of, 0.52%. The tax rate is, I saw it a few seconds ago, it is, there is a section called income taxes on here that we can, did they give it cost? Where is it? Here we are. So 27% for the last 9 months. 27%. The cost of debt we will calculate by taking, where's the interest expense? $253. Let's go, to work out the annual of it, let's just go 253 divided by 3, because this is the first 9 months, and then multiplied by 4 to get an annual figure of that. So about 337.33. So we go cost of debt, we'll say 337.333 divided by, so yeah, okay, so 4.38% we'll say is the cost of debt. Now the risk-free rate is, as of today on the 26th of October, it's 4.023%. 4.023%. Now these two, we have to do a bit more work. So for the beta, we need to know the industries that Tesla operates in, the unlevered beta for those industries, the revenues for those industries. Then what do I want after that? We want the EV to sales, then the value of each of those revenue segments. We need to know the proportion, then we can get our weighted beta. So, okay, let's pull up our spreadsheet. So I would put Tesla in these 4 categories: auto and truck, green and renewable energy, retail, automotive, software system and application. These ones, I think if we, no, let's go with auto and truck rather than the retail automotive. What are you doing? No, that's what we need. Okay, actually, no, let's do, forget this one. Let's go for these 3. Green and renewable energy, retail, automotive, software, system, and application. The unlevered beta for, okay, so 0.6 for the renewable energy, 0.67 for retail automotive, and 1.31 for software and system app. Yeah, that's good. The revenues for these are as follows. So the energy one is straightforward. We just put it equal to this one. Then retail automotive, we will put here. And the leasing, Then let's actually we'll put the credits there into that one as well. Into green and renewable energy. Then software, system, and app is just going to be services and other, because that's where the FSD and the robot are. So yeah, we'll go like that. The EV to sales, let me pull that up. Again, we want our price to sales data. I'll zoom in a bit more. We need this column. So 6.38, 1.22 for retail automotive, and 11.54 for system and application. The value of each of these segments are as follows. You do your revenues multiplied by your EV to sales. Just format it, then pull this down. We want to know what the total value is down here because we want the proportion. So you take the value of the segment divided by the total value. Lock it in. No. What am I doing? As so. Pull it down. Now we can calculate the beta, the weighted beta. You take your unlevered beta multiplied by the proportion. Pull that down. Go sum. And we'd have there. We have it 0.94 is what we expect the beta for Tesla to be. Now for our equity risk premium, we need to know where Tesla generates its revenues. We want to know the revenues for that region, the ERP, the equity risk premium for that region. Then what do we want from that? We want to know what the weight is, and then we can get the weighted ERP. So where Tesla generates its revenues, we come back. First of all, let's come back onto the 10Q. It was page 20-something. Somewhere down here. Here we are. Presents revenues by geographic area based on the sales location. So we'll go US, China, and rest of the world. The revenues for US are 36740. China is 14261, and this is for the first 9 months of this year. Then 18925 from the rest of the world. The ERP is, we have another spreadsheet for this. Let me bring it up. So we want down here. So we can see China is 5.25%. The US is, where is it? Yeah, 4.61. Then what I'm going to do, I'm going to remove the US. I'm going to remove China. Wait, why is this not updating? Pull them back. One second. Okay, I've got it. I know what I'm going to do. What we'll do is from the main list, I'm going to remove China. Where is it? Okay, so first of all, as you can see, this is the global equity risk premium, but we don't want the US and China because we would have a breakdown for that. We want a rest of the world without those two. And as you can see, this is a this is dynamically linked to what the weighted average of all of these will be. So let's take the US out of that. And as you can see, it will come up to 6.34. Now let's remove China. Where are you? Okay, so we get 6.69%. As a global, as a rest of the world equity risk premium. Let me just undo this before I forget. Yeah, looks good. What did we say? 6.69. So the weight is, we just need to sum the revenues up. The weight is your revenues divided by the total revenue. Lock that in. 2 decimal places. Then we just go ERP multiplied by the weight. Needs to be in a percentage though. Fill it down. And we just sum them up. 5.3%. F35. It makes sense because the majority of revenues are coming from the US and China. So it's not going to be a it's going to be a lower equity risk premium rather than if it was, say, generating its revenues from Latin America, Africa, where the ERPs are significantly higher. So yeah, so what's that? F35 equals F35. Okay, now we can calculate our cost of equity. The cost of equity equals your risk-free rate plus your beta multiplied by your equity risk premium. So let's put that into practice. Your risk-free rate plus your beta multiplied by your equity risk premium. No. Column width. Okay, so the WACC, we're just going to do this. Go equals, let's do it in brackets to separate the two, the equity and the debt. We go percentage of equity multiplied by the cost of equity, close brackets, plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus the tax rate. Just format it, 8.96. So the WACC we're saying is 8.96%. C19, which seems like it's quite low for a company like Tesla, but I guess because it doesn't have that much debt, it's mainly equity. Now, for the bare WACC, we're going to say plus 0.5%, the base plus 0.5%. Sorry, you need to put percent on there. Like that. For the bull, we minus 0.5%. The higher your WACC, the more bearish the situation is. For Tesla's terminal growth rate, let's go with 3%. Because, I mean, it is still a high growth company. Never put your terminal growth value above whatever GDP growth is. Okay, so in here, we want to have switches. We want it to be connected to the switches. So you go equals, instead of offset, you use choose. You select the switch, and then just the following cells, but in the correct order. There we have it. Just pull it and copy it down, and that's it, it's connected. So now come back down, add a row above your DCF segment and just put 1 to 5, but do it so you go 1, then put the cell plus 1, then copy it across. Now come down here. You want to take the present value of the unlevered free cash flow. You take your unlevered free cash flow, you divide by 1 plus your WACC, this cell here, because we want it to be dynamic so that we can flick between bull, base, and bear cases. Lock it in, and then go to the power of the year. Just pull that across now. There we have it. We want the terminal value now. And the way we get that is you take your final year of cash flows projected, multiply it by 1 plus the terminal growth value, divided by the WACC minus the terminal growth value. And so we have a terminal value of 436 and a bit billion. We want the present value of this now. So the PV of the terminal value, PV of TV, equals, you take the terminal value divided by 1 plus the WACC to the power of the final year. We don't, these ones don't actually have to be in bold. It's differentiated a bit. So now we have the present value of the terminal value and the present value of the unlevered free cash flow. We can calculate the enterprise value. That is done by going equals sum. You take the present value of the terminal value and all the forecasted present value of a free cash flow. There we have it. We want to add back in cash and subtract your debt to get the equity value. So let's do this. We know our debt because we've done it for the WACC. We just pull it from this sheet. Then the cash is on the balance sheet. So come to the top of the 10Q here. So we're going to go cash and cash equivalents and short-term investments. These are assets that can be changed to cash very quickly and can cover any short-term liabilities. So we'll say 18,289 plus 23,358. So it's about 41.5 billion in cash. The equity value now is you take your enterprise value, you add back in this cash, you subtract the debt, and there we have it. Next step is you find your diluted shares outstanding. And this will give an implied, we can get the implied share price from these two figures. For the diluted shares outstanding, come on to the income statement. And we want the 9 months ended, diluted, 3523. 3523. Okay. Now we go equity value divided by the diluted shares outstanding, and we get a forecast share price of, an implied share price of $102, K124. To work out the upside or downside, you take the implied divided by the current -1. So again, I mean, so it's at an all-time high. On a base case, this is saying that there's a 71% downside. The downside to Tesla, it is significantly overvalued. If we go on to the bull case, we would get a price of 124, which is not really that much higher. If we, I mean, eventually, let's say the EBIT margin goes up to 20%, what does that do? Not moving. Come back down. Sorry, it was, yeah, so let's say we want this at 20% instead, the EBIT margin. It's still significant downside on a bullish scenario. I guess this shouldn't really be surprising for Tesla when you consider that it's, you look at some of the, say the price to earnings ratio, what is that at the moment? Equals A1 open brackets, on a P of 311. So yeah, I mean, you can see why it is seen as overvalued. So yeah, I guess let's see what it would be on a really bearish scenario. 66. Wow. I mean, this all hinges on this EBIT margin being able to come back to the, where is it, the 2022 level, and then be able to grow from that. They would expect the full self-driving and the robot to be able to take it back to into more higher margin territory. But yeah, okay. Well, that's it for this video. Please do join for the next one and hit subscribe if you have not already. Thank you very much. Bye.